Carvana is experiencing some absolute carnage right now as their stock price is plummeting and they are actually at risk of complete failure. I mean, just take a look at this stock chart. Just look at it. Look at it, would ya? Anybody remember that from the old days of YouTube? But for real, if we take a look at their stock price back when they IPO'd all the way back here in 2017, they hit a low of about $8.20, and pretty soon after embarked on an upwards trajectory that was just printing money for all investors involved. Especially when we get to around here in 2020, when all the free money started to get printed, they just went on an absolute tear, peaking out in August of 2021 at about $376 per share. But as they say, good times never last, and when the bad times come, only the good companies will survive. And it didn't take long for Carvana to start to plummet, and it is now at an all-time low of $6.80 per share. This has prompted many on Wall Street to warn that they are at risk of insolvency very soon. Now, this points out something about risk management from the average investor's perspective that is absolutely vital to understand if you ever want to make money investing. Take a look at this chart from Bloomberg that shows more than a 1,000% gain that was fueled from just the bottom in 2020 up to the top in 2021. This is 1,000%, not 100%. 100% return means you doubled your money. This is 1,000% return. So the question is, what does it take to offset or wipe out a 1,000% gain? Does it take a 1,000% loss? No, it only takes a 98% loss. Losses are way more powerful than gains. This also means that if you reverse the two and you start off with a loss, let's say a 98% loss, it takes not a 98% gain to get back to even, it takes a 1,000% gain to get back to even. The order does not matter here. Risk management is key, and if you ever want to make money investing long term, you have to manage your risk first. Warren Buffett always says the number one rule is don't lose money, and the number two rule is don't forget rule number one. And by the way, I'm running a Black Friday Thanksgiving deal right now, 50% off for my portfolio allocation course to teach you exactly how to do just that, so you don't have to worry about your portfolio taking large losses. But Carvana clearly wasn't a fan of risk management, as they have gotten themselves into a very sticky situation, and right now they are cutting about 1,500 jobs. They have burned through billions of dollars in cash within just the last 6 months. Further, bond traders are trading their bonds at prices that indicate a high chance that they cannot pay those bonds back. As a result of this, price targets for the stock have also been lowered to reflect a high likelihood of insolvency. So what in the world is going on here? Well, apart from the fact that a company took on too much debt and started spending too much money during a false boom caused by artificially easy credit conditions, they were also in a bad business to be doing this: used cars. If you take a look at the price of used cars over the last couple of years, we can see that the response to COVID brought about a huge increase in the price of used cars. But that did peak about last year, and prices of used cars have been falling since. This means that all that inventory that Carvana purchased during that time at those higher prices, because they thought prices would keep on going up and they could keep on selling them, they're now having to sell those cars at either break even or losses just to keep paying the bills. And analysts are citing industry headwinds continuing in the near term future, with things like consumer sentiment and interest rates continuing to be a bad condition for the stock. I mean, cars are in a very similar situation to houses, where over the last couple of years, if people were interested in buying a car, they likely did it within the last few years when interest rates were at all-time lows. And yes, prices have come down a little bit, but nowhere near where they were pre-COVID. And in fact, when we look at the price of new cars, they did dip a little bit, but now they have been on the rise again. Now, this is more to do with the fact that cars are a lot more of a consumable product than something like houses. In fact, the inventory, absent new supply, of cars dwindles very fast because they get into accidents and they break down and they require money to repair, and they get older and they stop working. So people do have to continue to replace their cars. The other thing that is causing new cars to be pushed up in price is increasing government regulations about how and manufacturers can build cars. Manufacturers are legally not allowed to build cheap, reliable cars anymore because of all the new environmental regulations that go into cars and what kind of new EV and hybrid technology and what kind of gas mileage they can get. So manufacturers are continuing to have to make cars that are less reliable and more expensive. This means that cars are breaking faster now because they have newer technology that is less tested, and consumers are being forced to buy these things, and they cost more, higher prices, and as they break, then consumers are forced into buying yet again. And so while this does look like a very bad situation for a stock like Carvana that is engaged in the business of reselling used cars and has a ton of debt and looks by many measures to just not be a very well-run business, and they could go out of business very soon here, it doesn't look to me like this is one of those opportunities where people should be looking at used cars or even new cars saying prices for cars are going to plummet soon. For anybody that does have a lot of cash and is waiting on the sidelines hoping for the used car market or the new car market cars just to plummet in price, what you'd be looking for to happen is a big wave of unemployment where people cannot afford to pay their car bills, their auto loan bills anymore, and then those cars get repossessed and then resold. But apart from a massive wave of layoffs and unemployment and pay cuts, we're likely not going to see a massive wave of new supply hitting the market, even from companies like Carvana going out of business. And if the government has anything to say about it, the trend for new car prices will continue to accelerate as they continue to enforce more and more losses and unprofitable decisions on car makers and car buyers. But at least we can say we're greener, right? As long as we don't take into account all those extra lithium mines overseas. As always, I really appreciate you guys. Thank you so much for watching. Have a great day.